A very good morning, friends. So I hope you're all doing well. And most importantly, I hope you've made your revision on what we did in the previous class. Because I gave you a 7-step model as far as consolidated balance sheet is concerned. We are focusing right now on the consolidated balance sheet. We will come to the concept of a consolidated income statement as well. And I gave you a 7-step model, which I'll just take a very quick recap. And then we started off with a little complicated question, which I gave you the technique in terms of analysis of other equity. But I think first let's take a quick recap in the morning as far as the 7-step model is concerned. And this time we can just add on a few more inputs because I also gave you some adjustments as well. Typically, I gave you a total of 3 adjustments. We discussed the concept of elimination of intercompany owings. We discussed the concept of elimination of the unrealized profits, or what we also call a stock reserve, provided the sale of the stock is involved. And we did the concept of the adjustment of 3, which is a fair value adjustments. And I already said that your mind needs to be tuned very well that, if you're looking at a particular adjustments, which of these 7 steps is going to get impacted. Just to take a quick recap, that when it comes to the elimination of intercompany owings, the impact would be on step 7, consolidated balance sheet, irrespective it is upstream, irrespective it is downstream in nature. And when it comes to the elimination of the unrealized earnings, first focus is we eliminate only to the extent of the unsold goods, if any. And the treatment depends upon its upstream or downstream in nature. If it is downstream in nature, we'll take the impact in step number 6 as far as the profit is concerned, and step number 7 as far as the stock is concerned. But when it comes to an upstream transaction, I said, let's take the impact in terms of step number 2A, which is the analysis of other equity, and in terms of step number 7, where you would eliminate the profit from the stock. And as far as the fair value adjustments are concerned, we need to take the impact again in step number 2A, which is other equity. The fair value increase, decrease is pre, and additional depreciation or excess depreciation to be reversed is post. And of course, you also need to take the impact in step number 7. When you take the concerned asset, you need to add or reduce the fair value gain loss, whatever the case might be, and also to consider the fair value, the additional depreciation or the reversal of the excess depreciation. So now let's, I think, first take a little quick recap on the 7-step model, get the highlights, and then proceed further, where I'll give you the focus points which I just mentioned, and we come back to that interesting question number 2 in the study material. So I'm just starting with a quick mind map early in the morning so that we stand absolutely in agreement with our thought processes. So first of all, as I said, your step number 1 would be simply to concentrate on the percentage and the date of acquisition. You're never going to face any challenge in terms of step number 1, because this is just a simple exercise, reading the question, getting the date and the percentage, that's it. Then comes your step number 2, and here I would again like to remind you, though of course generally we're going to get a second category of question. The category 1 is where you are required to make a consolidated balance sheet on acquisition date. Without NCI is not an issue. Or you're required to make a consolidated balance sheet which is later date, 1 year, 2 years, whatever. And there is NCI or not. So I would say immediately as you come to the step number 2, your focus point would be to first of all look at the category of the question. This is the most important element you need to watch out when you're looking at step 2. Go on a very focused level at each stage, you'll never go wrong. So when you look at the category of the question, there will be 2 categories of the question. The category number 1 is that there is a consolidated balance sheet which is required to be done on the date of acquisition, or there is a consolidated balance sheet which is required at a later date. It can be any later date for that matter, 1 year later or maybe 2 years later, doesn't make a difference, but at a later date. Now, as you immediately identify the category of the question, your mind should get absolutely clear that which step number 2A or 2B, what are we applying? And I also gave you the insights very clearly at this stage that if you are required to make a consolidated balance sheet on acquisition date, you can directly proceed with the step number 2B. There is no need in terms of the step number 2A. So you can directly proceed with getting the list of the net assets. Now, when you're making the list of the net assets, you are going to take assets minus liability, because the balance sheet of the subsidiary on the acquisition date, which is also the consolidated balance sheet date, is given in the question. So getting the list of net assets, assets minus liability, is not a problem. So in this case, when you are required to make the list of the net assets, you will simply take assets minus liability. So there is no need to consider any equity share capital plus other equity in this case. Directly get the list. We've already seen a question on this area. I did the question of that Orange County, which is given in the study material, and that was pertaining to this particular case. We did the case with without NCI, both of them. Now comes the other agenda, that if you are required to make a consolidated balance sheet at a later date, you need to first of all go to the step number 2A. And in terms of the step number 2A, there is a need to split the other equity of the subsidiary in terms of pre and post. So you'll have to first of all make a split, do the analysis of the other equity. And now a couple of focus comings to my mind. So you need to consider the analysis of other equity of the subsidiary company, wherein I gave you that there are going to be a total of 3 focus points. There are going to be a total of 3 focus points as you go to the analysis. You need to consider, number 1, that the analysis of the balance sheet of the other equity needs to be done. Then you need to go to the additional information. Watch out for any fair value adjustments. And then you need to go for the focus number 3. Watch out for any unrealized profits or stock reserve, which is upstream in nature. So when you're looking at the analysis of the other equity, my advice is go on the focus points, the 3 focus points. You need to consider the analysis of other equity of the subsidiary company, which is in the balance sheet of the subsidiary. That's 1. Then you also need to consider the fair value adjustments. In the fair value adjustments, the fair value gain or the fair value loss is always going to be taken as pre-acquisition gain or loss. And you are also going to consider the additional depreciation if there is a fair value gain, or you are going to reverse the excess depreciation if there is a fair value loss, and that would be done in the post-acquisition column. So the moment your mind comes to the fair value adjustments, remember the increase or the decrease is pre. If there is an increase, you're going to get additional depreciation in post. If there is a decrease, then you're going to get a reversal of the excess depreciation in post. So this fair value adjustments will impact the pre and the post column. And then we also need to consider that if there is any kind of stock reserve which is supposed to be upstream in nature, take the impact as well, and the impact is going to be taken in the post-acquisition column. Because unless mentioned otherwise, we would presume that this intercompany sale, the sale and purchase between the parent and subsidiary, took place in the post-acquisition period. So we will eliminate the amount of stock reserve from the post-acquisition column. So you need to basically eliminate the post-acquisition gain from the post-acquisition column. So this is your focus in terms of step 2A. The moment you reach a step number 2A, you need to be clear when to use step number 2A and the three focus points in terms of step number 2A, which is a fair value adjustments and unrealized earning. Thereafter, we go on to the step number 2B. In this case, we go on to the step number 2B, which is getting the list of net assets, which is getting a list of the net assets. Unlike the first category of question where you've taken the assets minus liability, in this case, we'll never consider assets minus liability. And even if you want to consider, you will not be able to consider the data because he may not give you the assets and liability on acquisition date because the balance sheet of the subsidiary would be given at a later date. So how would you get the assets minus liability is going to be a challenge. So we will always land up using the technique of adding the equity share capital of the subsidiary company, and we're going to add the pre-acquisition equity, which you've already derived in step number 2A. You would have already done the analysis, and this other equity pre-acquisition is going to be available in terms of step number 2A. Now, there is another focus point, which of course I laid on more stress when I come back to the question number 2. Because when you're looking at this net asset, it is the net assets on acquisition date, which is there, which was available on acquisition date. So dividends is something which is going to create a little trouble. So we'll tackle the dividend as I explained in the previous class, which I'm going to give you a run through again. So be very clear on the concept of dividends. Then comes the input in terms of step number 3. Now, as far as the step number 3 is concerned, if it is a fairly simple question, then the calculation of the purchase consideration is not going to give you any challenge. But now let me just add on something to you because this is pertinent. You know, there is one very interesting thing which I believe, it's going to be very important when you do a bigger technical question. Many times you would notice the examiner will give you different forms of consideration. So he will say that as a parent company, you give different forms of consideration to the shareholders of subsidiary. But some form of payment is not yet incorporated. Could be a DC or it could be a CC. We will see those adjustments coming today. But my piece of advice is that, before these 7 steps, there could be a need to make an extract balance sheet as well. Before you even start with the 7-step model, there could be a need of making an extract balance sheet. Don't worry, you're going to get that flavor today itself. But if there is any kind of omissions, like for example, if there is a purchase consideration in the form of DC, which the parent investor is not even yet recorded in the books of accounts, that means the investment in the balance sheet is not the correct investment. So I would say that, before you start the 7-step model, see if there is any kind of omissions which are to be incorporated, where there might be a need to make an extract balance sheet. So once we look at the question, you'll get a more connect with that. But just keep in mind that before the 7-step model, an extract balance sheet could be required if there are any kind of omissions. If there is omissions, if any, then an extract balance sheet might be required. Other than that, when you're looking at step number 3, in terms of PC, your mind should go back to Ind AS 103. Because if there is any kind of PCs which are missing, your focus point is going to be on the 7 issues. Your focus point will be on the list of 7 issues which I gave you in terms of Ind AS 103. We've done in detail the concept of purchase consideration. The same agendas should come into the mind. DC, CCE, CCS, TC, PHI, SBP, pre-existing relationship. Any of those issues could be confronted here as well. Then you go on to the step number 4. Once we're done with the step number 3, then it is going to be a step number 4. Now let's add on some more inputs to you. Now let's add on some more inputs to you. If you remember the discussion on goodwill impairment in terms of Ind AS 103, you would also recall that as far as NCI is concerned, it can be at a fair value or it can be at a PASNA. And that would lead to a full or a partial goodwill as well. And if there is going to be a full or a partial goodwill, the impairment of the goodwill will also have some implications. So I think as I am making a walkthrough on the steps, indirectly I'm looking at now an adjustment number 4 as well, that if there is a goodwill impairment, what you need to do. After these steps, I'm also going to give you, a little summary of the 4 adjustments as well. So when you're looking at the calculations in terms of step number 4, that is NCI, you will calculate the NCI on date of acquisition, which is going to be a pure exercise based on Ind AS 103, where you would have taken the NCI at a fair value or you would have taken the NCI at a PASNA. And that focus you already know. Now, a little caution which is required at this particular stage is, first of all, when you consider the NCI in this case, you need to add the share in post-acquisition profits. You need to add the share in post-acquisition profits, and the share in the post-acquisition profits is what you are going to consider from step number 2. I would say step number 2A, analysis of other equity. But at this stage now, you need to be cautious of the dividends, which we'll talk later. As we come to question 2, we'll talk of dividends and give you the focus points. But I would advise, once you get this total, also remember that if there is impairment of goodwill, remember, if there is any impairment of goodwill, you need to reduce the impairment of goodwill, the NCI share. But the focus point is that the goodwill impairment will be borne by the NCI only if goodwill is full. That means if the NCI is at a fair value, not at PASNA. So when you're going to reduce the impairment of goodwill, this is only if NCI is at a fair value. If the NCI is at a fair value, then only the impairment of goodwill will stand reduced at this particular stage. Because in this particular case, if the NCI is supposed to be at a PASNA, the goodwill impairment is borne only by the parent company. So you need to get your focus very clear. The goodwill impairment is going to be borne by the NCI only if it is at a fair value. That's a focus point in terms of step 4. Now, in this case, when you consider the goodwill impairment, of course, you will consider the share of the NCI. You're going to consider the share of the NCI. Then we go on to the step number 5. And in terms of step number 5, you need to calculate the goodwill or the bargain purchase gain, or what you can call capital reserve. Now, there is one very common mistake, many students make. And I would like to pinpoint that common mistake at this stage itself, so that we be very crystal clear on the agenda. So when you're looking at the goodwill or bargain purchase gain, trust me, it is 100% same as Ind AS 103. It is 100% same what you did in terms of Ind AS 103. So you made your calculations of the goodwill exactly the way you did under 103. So once you calculate the goodwill, here also the impairment of goodwill is to be taken care. Now watch this carefully. Watch this carefully. You took the purchase consideration and you added the NCI. And in this particular case, you compared this with the net assets and you are going to get the figure of goodwill. Let's not close this. Let's not close this. Now, hear this very carefully, the common kind of mistakes which people do, which I think I just want to put it across. This NCI is on the date of acquisition. Mind you, this NCI is on the date of acquisition, so you need this figure. Many times what students do when they take the NCI, they'll land up taking the NCI, which is the last figure in the previous step. That is the NCI on the consolidated balance sheet date. So get the focus clear that when you're calculating the goodwill, you need the NCI on the acquisition date. So please pick the figure correctly from the acquisition date. Don't take the NCI which you've derived at the end. And another important input, this of course you're going to pick up from step number 2B when you calculate the net assets. The PC is what you're going to get from step number 3. And this is what you're picking from step number 4. But you need to pick up the step number 4, this particular figure, which is on the acquisition date. Now comes again a very, very crucial point, which again is a very common mistake students do make in this case. Here again, once you calculate the goodwill, you also need to reduce the impairment of goodwill. You also need to reduce the impairment of goodwill at this particular stage to get the final figure of goodwill at this stage. Now, let me tell you one thing. At this stage, do not get sentimental. Don't start looking at the fact, oh, goodwill impairment, so is the NCI at a fair value or is the NCI at a PASNA? It doesn't make a difference to me. This is a figure of goodwill. I am not allocating the impairment between the parent and NCI. This is only getting the new figure of goodwill. So what you will do, you will reduce the entire impairment loss from here. Do not consider that I need to consider holding share or I need to consider entire goodwill depending upon NCI at fair value or PASNA. No. This is a goodwill figure. If it is a goodwill figure, you just need to consider that whatever is the entire goodwill impairment. Don't even bother whether it's a full goodwill or it's a partial goodwill. You just need to calculate the revised goodwill figure. So don't consider at this stage the share of any company. This is a common mistake. What people end up doing, they say that if NCI is at fair value, let me reduce the holdings impairment. And if the NCI is at PASNA, let me reduce the entire goodwill. You will reduce the entire goodwill impairment irrespective it is NCI at fair value or NCI at PASNA. Doesn't make a difference. This is a revised goodwill figure. So this is supposed to be based on the share, but this is the entire goodwill itself. So that is another adjustments. We are discussing goodwill impairment in the flow of our mind map. Then we go on to the step number 6 after this. So once you've done this, we go on to the step number 6 after this. And in terms of step number 6, the focus is to get the other equity which will appear in the consolidated balance sheet of the company. Now, when you're looking in terms of the consolidated balance sheet, other equity, your focus points again is now going to be on a total of 3 things. I would say 3 focus points again. So you would consider, first of all, as a base, holding companies own other equity. So this is going to be considered as a base that you are considering the other equity of the holding company. Now, I would say again, when you consider the other equity, 3 focus points. The 2 kind of steps which are complicated is step number 2A. And I would say step number 6, rest there is not much issue. In step number 2B, step number 2A, you already seen the 3 focus points. And I would say generally, even in this particular step, you'll get at least 3 focus points to watch out. Now, what are the 3 focus points which you need to consider in this particular case? The 3 focus points which you need to consider is, number 1, you need to consider the holding company's share in post-acquisition profits. The holding company share in the post-acquisition profits. And the holding company share in the post-acquisition profits is going to be available when you are going to look at the step number 2A. because you've done the analysis of equity and the pre-post figure is available. So this information will be available in terms of step number 2A. Now, another focus point which is already seen is the elimination of the stock reserve, which is the unrealized profits, but this time it is pertaining to a downstream transaction. It is pertaining to a downstream transaction because what you took in terms of step number 2A was upstream in nature. But what you're considering now is supposed to be a downstream impact, so the elimination will be done. And I would say the third focus point is the impairment of goodwill. It is the impairment of goodwill. And here again, many students do a very common mistake again. When it comes to a goodwill impairment, there is another very common mistake done. And I'll just, quickly also connect you to the dots as well. Now, in this case, when you're considering the other equity, you need to be careful that as far as the NCI is concerned, if the NCI was supposed to be at a fair value, we got a full goodwill. And if your NCI was at a PASNA, we got a partial goodwill in this particular case. I'm just adding that, impairment of goodwill adjustments as a focus point. When the NCI is at a fair value, you get a full goodwill, and if it is at a PASNA, it's a partial goodwill. Now, when it is a full goodwill, we will reduce the holding company share of impairment. I will reduce only the holding company share of goodwill impairment. If it is a partial goodwill, then I need to reduce the entire impairment of goodwill loss because entirely borne by the parent company itself. Let's please get the dots connected. Let's make a walkthrough in terms of three things. One is the NCI, the impact of impairment on NCI, the impact of impairment on goodwill, the impact of impairment on the other equity. Your step number 4, step number 5 and 6. When there is a goodwill impairment, you need to be clear what is done in step number 4, step number 5 and 6. One thing. In step number 5, don't get sentimental, as I said earlier. I'm not even concerned it's partial or full goodwill. The idea is to get the revised goodwill. So in step number 5, you just need to reduce the entire goodwill. That's it. Now, when you're looking at step number 4 and step number 6, if the NCI is at a fair value, NCI share in step 4, parent share in step 6. Get this clear? So if you say that the goodwill is full in nature, then NCI impairment from NCI, parent share from the step number 6. But if the goodwill is supposed to be partial in nature, nothing in NCI, nothing in step 4. Everything gets reduced from the step number 6. So your focus is more on step 4 and 6. NCI at a fair value, divide the parent share and the NCI. Parent from step 6, NCI from step 4. If the NCI is at a PASNA, then the goodwill impairment totally from the parent. Step 6, nothing in step 4. In terms of step 5, you just need to reduce the impairment irrespective PASNA, fair value, whatever. So this is one area which needs a focus points. And then finally, after this is done, you go to the step number 7. And the step number 7 is in terms of making a consolidated balance sheet, wherein I've already given you the 5 rules of making a consolidated balance sheet. Wherein in terms of the 5 rules, we've already seen that number 1, the investment which the parent gets in the subsidiary doesn't appear in the console, never ever. We've seen the equity share capital of the subsidiary company never ever appears in the console. And we've seen that the other equity of the subsidiary company, only to the extent of pre-acquisition, never ever appears in the console. So you get 3 focus points. that, these three items don't appear in the console: investment, pre-acquisition other equity, and the equity share capital of the subsidiary company. But there is something which appears. And what appears in this case is you aggregate the assets and liability always 100%. Because the technique of consolidation is called a full consolidation method. So you need to aggregate all the assets and liability. And finally, we've also seen that goodwill and the NCI are going to appear as a separate line items in the consolidated balance sheet as well. So this is the summary, the mind map, as I promised in the last class. If you've made your revisions well, you would have seen that I've tried to condense all the inputs of discussions, though we spent a good time of almost half an hour, but I think it was worth it. Wasn't it worth it indeed? Say a yes. Okay, and before we go on further, I'd just like to give another focus summary as well at this stage. So you need to keep these 7 steps, and I'm again insisting, insisting, you need to proceed in a sequence manner. Because when you proceed in a sequential manner, your focus is very clear in terms of what is done at each and every step. Okay, now, there's a little last input to give you before we proceed further, because your mind needs to be very much tuned on the adjustments which I gave you. Now I've given you a total of 4 adjustments now. So your mind should be clear when you read the question that what are the kind of adjustments, where does the hit take place, though already incorporated in the mind mapping, but I'm just trying to make a summary of adjustments as well. I'm making a summary of the adjustments also. So we're looking at the adjustment and we're looking at the treatment of those adjustments within my 7-step model. So when you read the question and you look at an adjustments, immediately your mind should tell me that, okay, this adjustment is going to be step this and step this, tuning. So I would say the first adjustment is regarding the intercompany elimination. So one is regarding the intercompany elimination, wherein we've already seen it doesn't make a difference whether it is downstream in nature or it is upstream in nature. You directly take the impact in terms of step number 7. You directly take the impact in terms of step number 7, just eliminate the common debtor, creditors, upstream, downstream, doesn't make a difference. The second input which I gave you was in terms of the unrealized profits. Is in terms of the unrealized profits, and this definitely depends upon, is it a downstream transaction or is it an upstream transaction? If it is supposed to be a downstream transaction, you take the impact in step 6 and step 7. If it is upstream, you take the impact in step 2A and 7. So in terms of the downstream, you take the impact in terms of step number 6 and step number 7. Unrealized profit in 6 and the stock reduction in 7. If it is upstream in nature, you take the impact in step number 2A, that is in the post-acquisition column, and in terms of the step number 7. Get this very clear. And then I gave you the inputs in terms of the third adjustments, and that is supposed to be fair value adjustments. That is supposed to be a fair value adjustments. Now, in terms of fair value adjustments, you're going to take the impact in terms of step number 2A and in terms of step number 7. 2A in terms of fair value gain loss, additional depreciation, pre-post, whatever. So fair value adjustments impact goes in terms of step number 2A and in terms of step number 7. And then finally, we've also added in our mind mapping today the fourth adjustment, that is what I call the goodwill impairment, the impairment of goodwill. So the next adjustment which comes in mind is the goodwill impairment. Now, as far as goodwill impairment is concerned, in this particular case, I would say your treatment depends upon whether it is full or partial in nature. So when you look at the goodwill impairment, it depends whether the goodwill is full or the goodwill is partial, depending upon the NCI status. If the goodwill is full, you take the impact in step number 4 for the NCI, the goodwill in step number 5, and the holding share in step 6. So this will impact, you can say, the step number 4, the step number 5, as well as the step number 6. But when it comes to a partial goodwill, there is no impact on the NCI. So only in terms of step number 5 and 6. So in this particular case, the impact goes only on step number 5 and in terms of step number 6. This is also a very important key summary of how various adjustments will impact with step. I hope, friends, you must be feeling a little more confident if you revised, because that's important terms and conditions. So if you have made your revisions well, you would have got the entire crux in terms of what is done where. Now I think we are ready to come back to that question number 2, which we started off. And I said, we did the analysis of other equity, but now we are doing everything with forecasts. So let's take it further. Let me now come back to the question number 3, which is given in the study material. I have taken this question separately, but it is given in the study material. So I have taken this question from the study material itself. So just taken the separate extract of this question. Let's look at the question number 3. We did the analysis of this other equity, but we're now going to do things with a big focus indeed. That's wonderful indeed. Let's now take it further. I'm now reading the inputs once again, and you will decide the category of the question as well. We've done the first category, and doubtfully it is second category now. It says DEF acquired 100% ordinary shares, no NCI, on 1st October X1. On 31st March X2, 6 months later, the balance sheets of the companies are given. The retained earnings of XYZ shows a credit balance of 3 lakhs on 1st April X1, out of which a dividend of 10% is paid on 1st November. DEF credited the dividend received to the retained earnings account. Well, I guess if the parent received a dividend, naturally, he's going to give a credit to the retained earnings. So what he did was correct. But if you look at from a group point of view, there is no income. Because from a standalone financials, you get a dividend. It is supposed to be your income for the standalone financials. But from the group point of view, it's not your income. So you need to eliminate this income when you are going to do the consolidated balance sheet. So you need to be very clear, this is going to impact with step. Since you've taken a credit to the retained earnings and it needs to be eliminated, this is going to impact my step number 6. So there will be an impact of this in terms of step 6 to eliminate this amount of income, which is not income from the group perspective. Fair value of plant and machinery is given and the depreciation rates given, step number 2A and step number 6. So we note down that this is step number 2 and step number 6. Step number 2A rather. Then he says the following are the increases on comparisons of the fair value with the book value on 1st October. So this is also all the fair value adjustments. And we are very clearly given, it may be assumed that the inventory is still unsold on the balance sheet date and the trade payable are not yet settled, so that I can add these fair value adjustments to inventory and in terms of payable. And assume that the other reserves on balance sheet date is same as on 1st October X1. Right, friends, so let's now start the journey. So I did the analysis of this, but today we're going to do this analysis jointly and then take things forward. So now we're going to focus step by step. As I proceed, please think on a step-by-step line. So this is the answer to the question number 2, which I pointed. So I'm starting with my step number 1. And in terms of step 1, just focus that I need to consider the date of acquisition. I need to consider the percentage of holding as well. So if I go back to the date of acquisition, it is 1st October X1. My date of acquisition is 1st October X1 and the percentage is 100%. There is no NCI in the question. Now we go to the category of the question as you go to the step number 2, category. So we go to the step number 2 to identify the category. You don't need to tell the examiner about this category. Well, this is for your own self-calculations. Don't tell him that this is the category made at a later date. So you need to decide the category of the question. So what is the category of the question? Are you making a consolidated balance sheet on acquisition date, or are you making a consolidation at a later date? Undoubtedly, it is a consolidated balance sheet at a later date. So my mind immediately tells me that if it is a consolidated balance sheet at a later date, I need to go for a step number 2A also, and I need to go for a step number 2B also. This is what I need to conclude. Simple and straight. Okay, now comes the agenda in terms of the step number 2A. Now comes the agenda in terms of the step number 2A. Now, as you come to the step number 2A, your mind should start working on, I have got 3 focus points. The balance sheet of the subsidiary other equity needs an analysis. I have any upstream stock reserves. I've got any fair value adjustments. 3 focus points should come to the mind immediately. And whenever you're going to do the analysis of other equity, whenever you're going to do the analysis of other equity, make an interesting chart. Don't compromise on the formatting. So we're going to create a small little format and we're going to take 3 columns. One is the column which is for particulars, and one is a column for pre-acquisition profits. We need to basically split the profits in terms of pre and in terms of post. So pre and post acquisition. And take a minute to define the pre and the post acquisition in terms of dates. Be careful and define this in terms of dates as well, that what is pre, what is earned before acquisition date, what is post, what is earned from acquisition date till the balance sheet date. So this is pre-acquisition date, 1st October X1, acquisition date. And this is anything from the date of acquisition till the balance sheet date, that is March X2. Define it clearly. Tell the examiner regarding what is pre and what is post acquisition in nature. Now let's go to the balance sheet and focus out there. So I'm looking at my focus point 1. So I'm going to first of all look at the balance sheet of the subsidiary company and focus on the other equity in the balance sheet. So once you go to the balance sheet of the subsidiary, we can clearly see that there is an other equity comprising of 2 items. One is the other reserves, which is appearing to the extent of 10 lakhs, and one is the retained earnings, which is appearing at 820. So once you identify the items in the other equity, pick them up one by one. So let's begin with, let's say, other reserves itself. So let's begin with the analysis of the other reserve. Now, when you do the analysis of the other reserve, my advice would be make a time scale always. When you're doing this analysis, please focus on creating a time scale. Make it a habit that you need to make a time scale to get things organized. So we know that the financial year is starting on 1st April X1, ending on March X2. And you also know that your date of acquisition is supposed to be in the middle of the year, that is on 1st October. So note down carefully in this particular case, what is the time scale, the beginning of the year, the end of the year, and the acquisition date is in the middle of the year. Now, if you look at the other reserves in the balance sheet, it is appearing at 10 lakh. And it's clearly given in the note number 2, assume that other reserves on March X2 is same as on April X1. So your other reserves at the beginning of the year, the other reserves at the end of the year was same. So just note it down that this was the balance at the beginning and this is also the balance at the end. So I'm sure you can easily now define me. This is the balance before the acquisition date. Can I say entirely pre-acquisition in nature? There is no increase in the post period, so the entire amount is pre-acquisition in nature. Analysis of other reserves done. Had there been a difference in this particular case? Can I say the difference is during the year? It's a reserve addition during the year. I could have comfortably divided in a time ratio. In this case, since the balance at the beginning and end is same, it's entirely pre in nature. Great. Now let's have a look at the next item, and the next item is the retained earnings. Again, make your time scale, get the date 1st April, get the date 31st March, and also organize that in between on 1st October, there is a date of acquisition. Organize the information very carefully. I'm saying this because you need to go step by step. Now, if you look at the retained earnings in the balance sheet, it is appearing at 8,20,000, and we are given in the additional information, the retained earnings was 3 lakhs on April X1, but out of which a dividend of 10% is paid on 1st November. A 10% dividend on 20 lakhs comes to 2 lakh rupees. So the balance at the beginning was supposed to be 3 lakh rupees. And the balance at the end is supposed to be 10 lakh rupee. Now, when you're doing this analysis and you confront a dividend, caution. When you're doing this analysis and you get a dividend, it is again time to be a little cautious. Now, this 3 lakh is something which was there on the 1st April, but by 1st November, you paid a 10% dividend on 20 lakhs, which is 2 lakh. So naturally, by the end of the year, this money is already paid. So out of this 3 lakh rupees, when you paid a dividend of 2 lakh rupee, so what is still available is to the extent of 1 lakh. So you compare this 1 lakh and the figure of 10 lakhs. No, it's not 10 lakh, I think. That was 820, my mistake. So this figure is supposed to be 8,20,000. So once you compare this figure, which is 2 lakhs versus 1 lakh versus 8.2, you'll get the change in profit. Now, I'm just going to say a sentence which I said last time, and I am also going to work upon that in the next 5-7 minutes. Now, there are two things. If somebody says that what is the retained earnings on 1st October, I'm not saying 1st April, I'm saying 1st October. I'm saying out of this 3 lakh, what is the retained earning still available on 1st October? 3 lakh. If somebody were to say that out of this 3 lakh, what is still available on the balance sheet date, I would say 1 lakh. So there are two different things. The balance at the beginning of the year, which is 3 lakh, is it still available on the acquisition date? Yes. But is the balance of 3 lakh still available on the balance sheet date? No. So you need to be careful that 3 lakh was still available on 1st October. But the 3 lakh was not available on 31st March because dividend is paid on 1st November after the acquisition date. So what we're going to do in this particular case, since you are creating this column for the purpose of calculating the net assets on acquisition date, the best thing to do in this outer column is take 3 lakh and not 1 lakh. I will take the figure out here, which is the RE still available on 1st October. So we will write down 3 lakhs in the outer column. So let me put an asterisk. So what I'm going to consider, I'm considering what is still available. I'm considering what is still available on date of acquisition. So this is still available on date of acquisition. It may not be still available on the balance sheet date, but my focus is on the acquisition date. So when there is going to be dividends, please remember that the figure which you need to take in the outer column is the one which is still available on acquisition date, not balance sheet date. I hope I made my point. And then the difference of 7.2 lakhs is earned during the year, so that 7.2 lakhs can be divided in the time ratio. Now, when you divide this in the time ratio, create a separate column that is retained earning. There is no need to split the other reserves and RE in the pre-column, but you must segregate in the post-acquisition column that this is other reserve and this is RE, because the post-acquisition shares RE will be added to RE, post-acquisition other reserve will be added to other reserve. So get into the habit of segregating these columns between RE and other reserve. I hope, friends, I've made my points very, very clear. So this is only one focus point, the balance sheet of the subsidiary company. Once you go to practice, you'll get a definitely good hold in terms of things. We continue with this analysis because we've got another 2 focus points as well. So we continue with this analysis. We've got another 2 focus points. So in this particular case now, when we come to the analysis, this is continued pre-post. Now, the next focus point is in terms of the fair value adjustments. You can give headings, that's not a problem. The balance sheet of the subsidiary, one focus. The fair value adjustments, another focus. The stock reserves, another focus. Now, in terms of the fair value adjustments also, my advice would be continue to do the time scaling. When you did the balance sheet or the equity analysis, we did a time scaling. I would say even for fair value adjustments, make your time scales. It'll save your any kind of mistakes. Now it says in the additional information, the fair value of the machinery on 1st October X1 is 20 lakh. The depreciation rate is 10%. Now this plant and machinery is appearing to the extent of 1350. But this is on March X2 and it was 20 lakhs in the middle of the year. So what we're going to do, we will again organize for the plant and machinery a time scale that is 1st April and ending on 31st March. The figure which is appearing in the balance sheet at the end of the year is 13.5. So now since you want to get the fair value gain loss in the middle of the year, there is a need to do a backward calculations. If your depreciation is at the rate of 10%, that means this represents 90%. And if this represents 90%, you can gross it up and make it equal to 100%. So let's see what is 100%. I guess would be 15 lakhs. 13.5, that's right, is 90%. So 100% becomes 15. Now, you need to remember that when you're looking at a fair value adjustments, there are 2 focus points: getting the fair value gain or loss in the pre and getting the additional depreciation or reversal of the excess depreciation in the post. So in this particular case, we'll now organize the data. So we on 1st October was a date of acquisition. So I need to first of all get the book value on this date. Now, since this 15 lakhs is the balance at the beginning, we just need a 6 months depreciation to get a book value in the middle of the year. Simply speaking, 1.5 lakhs is the 12 months depreciation. So 75,000 is a 6 months depreciation. So 15 lakhs minus 75, that makes it 14.25 lakhs. and this asset was revalued at 20 lakh rupees. So we're going to get a fair value gain. And this fair value gain is going to enter in the pre-acquisition column. So this is 5.25 lakhs is the fair value gain. This enters the pre-acquisition column. Since there is a fair value gain, now there is a need to consider the additional depreciation as well. And we're going to consider the depreciation on a prospective basis. So if I were to consider now the impact of the additional depreciation, here again on the additional depreciation, we need to be a little more careful at this stage. Reason: there is no impact of any additional depreciation for the first 6 months, but there is an impact of the additional depreciation over the next 6 months. We took a depreciation on 15 lakhs, but we should have taken a depreciation on 20. You put a question that I have taken a depreciation on 15 lakhs, but I should have taken a depreciation on 20. So when it comes to the additional depreciation, we will take on 5 lakhs at the rate of 10%, and this is going to be prospectively only for a period of 6 months. That I think works out to 25,000, I guess, and put it in the brackets. This is again going to be reduced from the retained earnings itself. So this takes care of one of the fair value adjustments. There are more fair value adjustments in the question. So we continue this analysis further. Same columns, pre and post. So this is again continued as pre and post. We've got some more fair value adjustments in the additional information. Now, in the first plant and machinery, fair value adjustments, we have given the depreciation rates. We've taken the additional depreciations impact, etc. But for the other adjustments, we're not given any detailing. So we're just given that following are the increase in the fair value compared to the book value on the 1st October. So any gain on the asset is again any increase in the liability loss. So land and building is 10 lakh. So we've got land and building. This is pre, that is 10 lakh. Then there is inventories. I think it was 1.5 lakhs. And trades payable was 1 lakh increase. So that's in the brackets. The assets are changing. That's again, the liability is increasing. That's a loss. My focus point number 2 is done. Then comes my focus point number 3. That is, if there is any upstream stock reserve. There is no upstream stock reserve in the question. Isn't the life becomes simple when you go on a step by step? Your focus is very clear. What is to be seen at each stage? Brilliant. Let's now consider the sum total of all this, and we will get what is the total of pre and post. So this is
pre-acquisition 32 lakhs 85,000.
32 lakh 85,000, and the post
3 lakhs 35,000.
3 lakh 35,000 is supposed to be the post. Wonderful indeed. Okay, now with this inputs in hand, I am ready to go to the next step. I know I did this calculations in the previous class, but I think now you should get a 100% hold. Say yes. Did you get a 100% hold on the analysis? Not even 99. Very good. Okay, not many people said a yes on that. I hope you did a practice with your own hands on this analysis. Say a yes. Okay, I think Sanya tells me yes, and I think Ginny tells me yes. Okay, rest everybody silent. Silence is millions a word. Okay, then we go on to the step number 2B as well. And in terms of step number 2B, we need to get the net assets on date of acquisition, and we decided we need to consider the sum total of the equity share capital and the pre-acquisition equity. That's it. So equity share capital, I think, of the subsidiary was 20 lakhs, if I rightly remember. And the pre-equity is 3285. So this is 32,85,000. And then we go on to the step number 3. And in terms of step 3, we need a purchase consideration. I guess in this case, getting a purchase consideration is not a big deal because that is already appearing as an investment in the balance sheet of the parent. So if you look at the investment in XYZ is appearing at 34 lakhs in the balance sheet. So we can comfortably take this 34 lakhs out here. So this is a total of 34 lakh. Then we go to the step number 4, where we need to calculate the NCI, and we need the NCI now on the consolidated balance sheet date. So you need the NCI on the acquisition date, and to which you need to add the post-acquisition share as well. Am I given the status of the NCI in the question at a fair value? No. So I guess we need to consider the NCI at a PASNA in the absence of any fair value information. So we will take the NCI on date of acquisition. So your net assets was to the extent of, this is 52.85 lakhs. This is the net assets. Okay, so now, okay, and in this case, I think there is no NCI. In this case, there is no NCI because 100% belongs to the parent. I did a little more technical discussions. Let that be in the next question. Let's not discuss at this stage. So the NCI is not on the date of acquisition. There is no NCI. So then we go on to the step number 5, and this is calculating the goodwill or the bargain purchase gain. Take the purchase consideration, add the NCI, and you get the sum total, compare it with the net assets, and you're going to get the goodwill as well. So what was my purchase consideration? It was 34 lakhs.
30 lakhs.
Yes, no NCI. So this is 34 and this is 52.85. Unfortunately or fortunately, there is not a goodwill, but capital reserve.
18 lakhs 85,000.
18.85 lakhs is the bargain purchase gain, or you can call it as a capital reserve, which we will directly add it to the other equity in the balance sheet. Okay, so this is step number 5. Now we need the inputs in terms of step number 6. How many focus points in terms of step number 6? Other equity consolidated balance sheet. How many focus points? 3. Holding share in subsidiary post, and then there is goodwill impairment, and then there is unrealized profits. In this case, there is no goodwill impairment, there is no unrealized profit, just the parent share in the post acquisition. In fact, I am thinking that, sometimes when you make this step number 6 in a bigger question, you could actually make a statement of changes in equity, reflecting an extract as well. Let's do that. I think let's do that. Let me just make a proper calculations of the step number 6. Let's make it presentable as well. So let's go to the step number 6, where you can present the consolidated balance sheet, other equity, wherein you can show a proper statement of changes in equity. And though this is not a tab 1 or a tab 3, but yes, there is tab 3. So I think let's do that. Let's make it a little better presentation. So in this particular case, one column for the particulars, and I'm just taking a tab 2 and 3 because there is no tab number 1 in this case. I'm going to call this as tab number 2, and there is a tab number 3. The tab number 2 is going to comprise of a capital reserve and retained earnings, and I think there was other reserves, I guess. I'm assuming that those other reserves could be in terms of tab 3. So let's call this as other reserves as tab 3. So we can just organize this in a more systematic manner, that we've got a retained earnings, capital reserve arising because of the goodwill bargain purchase gain and other reserves. So let's consider the data. So let's see what is the holding company's own status. Go back to the balance sheet and see what is the status of the parent company's figure. Can I say other reserves is 24 lakhs and the retained earnings is 572. So retained earnings is 572. So let's fill in the figure. The retained earnings is 572 and other reserves is 24 lakhs. This is holding company's own. Let's see what was the capital reserve. It was 1885, right? The capital reserve was 1885, that's right. And we can consider the share in post-acquisition. So for the share in the post-acquisition profits, you need to go back to the step number 2A. Let's go back to the step number 2A to see the share in the post-acquisition. So this 335 is the post-acquisition profits, purely belongs to the parent company. So this is going to be added in the RE, that's 335. And is there anything else which also needs to be adjusted? There is, you tell me what. Anything else to be adjusted as well? That becomes like a fourth focus points now. So you've taken holding share in subsidiary post, there is no goodwill impairment, and there is no stock reserve. Another point, dividend.
Dividend.
Can I say the parent company added the dividends to its RE, but from a group point of view, it's not an income. You need to eliminate the dividends. So let's see what was the dividends he received.
2
I
lakhs.
think 2 lakhs was paid, 100% belongs to the parent company, eliminate this. So what we are doing in this case, we are saying it's not an income from group point of view. It's not an income from the group point of view. So there is a need to eliminate this money because it's not an income from the group perspective. Wow, I think this is done. Now let's see what is the sum total of these figures. Consolidated balance sheet. This is 1885 itself. And this is going to be 24 lakhs itself. Let's see what is the RE. $572 plus
7 lakhs
20.
10,000.
Right, 707. And in the balance sheet, we can take a sum total of all this and represent it as other equity. So let me just add all this up as well. Is it coming to 4992, I think?
Yes, sir.
Right, so this is coming to 4992. This is the sum total out here. Okay, now I think we're in a comfortable position to make a consolidated balance sheet also in this particular case. So let's go to the step number 7 finally. So step number 7, you need to keep those golden 5 rules which I gave you for making a consolidated balance sheet. So let's start with the asset side of the balance sheet. And now you need to keep your focus very clear. We've got fair value adjustments. So when you go to consider the PPE, etc., the fair value changes, the additional depreciations, all that needs to be incorporated as well. So let me go back to the balance sheet once again. So I'll just give you the figures, just I think carefully. Let's look at them. Land and building is going to be 15 plus 18, and there is a fair value gain of 10, no depreciation. 15, 18 plus 10. So we can consider land and building. This is 15 plus another 18 plus another 10, which is a fair value adjustments. Let's see the total. 43.
Yes, sir.
Correct. So this is 43 lakhs. Then we consider the plant and machinery. Let's go back to the plant and machinery as well. Now we need to consider depreciation as well. So this is going to be 24 plus 1350 plus the revaluation gain minus the depreciation. So 24 plus 1350. This is 24 plus 1350. What was the revaluation gain in the analysis of equity?
575.
575. And what was the additional depreciation, beta?
Additional depreciation 25,000.
25,000 additional depreciation. So we'll keep taking the impact of the fair value adjustments and the additional depreciation.
43 lakhs it comes to again.
Okay, wonderful. So this is again 43 lakhs itself. Least we forget there was no goodwill. So goodwill is not to be taken. And then investments will not appear in the balance sheet. Then you've got inventory. Inventory is going to be a total of 12 plus 364 and plus 150. 12 plus 364. So inventories, this is going to be 12 lakhs plus 364 plus we consider 1.5 lakhs, which is the fair value change of the inventory. 17.1.
17 lakhs 14,000.
40.
14. 14.
Okay, my mistake. 17.14 lakhs is the total inventories. Okay, let's go back to the balance sheet further and see the further inputs on the current assets. I guess we can take the trade receivable. There's no adjustments. So 598 plus 4 lakh. 598 plus 4 lakh is the trade receivable.
9 lakhs 9.
598 plus 4 lakh, that's 998.
Cash
And then
and
there is a cash also. You can just simply add the cash as well.
2 lakhs 25,000 it comes to.
2 lakh 25. I'll just write down the breakup also. Can you just give me the breakup of the cash?
1 lakh 45,000 plus 80,000.
Okay, that's wonderful indeed. So this is as far as cash is concerned. I think that's it. Nothing else is there on the asset side of the balance sheet, I guess. Let's see the sum total of this.
Asset total 1 crore 15 lakhs 37,000.
1 lakh 15, 37,000.
Yes, sir.
Okay, brilliant. So now let's go to the liabilities side of the balance sheet as well. And on the liabilities, we'll first begin with the equity section. And we need to consider only the equity share capital of the parent. Other equity from step number 6. NCI is not there, but for the time being, let's put it. So let's see what is the equity share capital. 50 lakhs. Right, so it is 50 lakhs out here. So this comes to 50 lakhs, and as far as other equity is concerned, 49.92 lakhs. Step number 6, we've just calculated out here. NCI, of course, is not there. Then I think we've got just 2 more liabilities on the balance sheet.
Trade payables.
Yes, there is a bank OD and a trade payable, 8 lakh. And trade payable, there is a 1 lakh change as well. So bank OD is 8 lakhs. So let's take the bank OD, that is 8 lakhs. And can you give me the breakup bit for the trades payable?
So 4 lakh 71,000 and
4 lakh 71 and
2 lakh 74,000.
2 lakh 74. And there is a fair value increase, I think 1 lakh, correct?
Sir, after taking that effect, I have taken that.
Okay, so what is the total of the trades payable?
For 7 lakhs 45,000, sir.
7 lakh 45,000. And C is the balance sheet agreed. I'm putting the answer in advance, assuming optimistic it would agree.
Sir, The trade payables bracket figure, 2,74,000 is after that 1 lakh effect.
Okay. So I think I'll make that as 174 to be on a safe side. So this is 174 plus 1 lakh fair value change.
Balance sheet tally, sir.
Wonderful indeed. Great. So this was a comprehensive question, but if you ask me, I mean, it's not a very great kind of a question, though you might have seen that there are a lot of complications. But if you ask me, it's not too technical indeed. But can we get such question in the exams? Yes, such questions have already come in the exams as well. So if you now notice, this was a case without NCI. We want to do something similar with an NCI, because that NCI is going to create a little more complications in life. Okay, so let's, I think, go back and let's now have a look at another question with you. This is an examination question, what I'm looking at.
Sir,
Hanji beta.
in last step that the way we prepared this consolidated balance sheet, can we prepare the same in an exam? Means showing that calculations in bracket.
No. Technically, you should make some separate working notes for certain items. Otherwise, I'll suggest a very good approach as well, which you can do in the exam. Do one thing that, make a column holding, subsidiary, elimination, total. Then it's fine.
Okay, sir.
Because at least, where somebody would see it's more like an Excel sheet kind of a thing, where you see that there is a parent company figure, there is a subsidiary company figure, and then elimination figure, and then a total. So then I think it's fine. Then you show the appropriate column, but don't show it in a little scattered manner. Present it well. Maybe I can do that in the next one.
Okay, sir.
Yeah. Okay, let's now have a look at an examination question with you. This is May 2018, 15 marker. The question is almost similar, except that there is an NCI as well in this particular case, which makes it a little better. This question came in May 2018, and if I rightly remember, this was the first attempt of the new course which was introduced on Indies at that time. And this was the first kind of question which came on Indies 110, May 2018. First time there was a parallel run for the old and the new course. And this was the first question which came in the exams at that time. Similar to what was there in the study mat, only except that there was, an NCI introduced in this case. Let's read. Oh no, this is 100%. I don't think so. I should do a similar question, right? This can be given homework, right? I think so. You want me to do something similar? Can I give you homework?
Yes, sir.
I think you can try. This is absolutely similar. Maybe we can just quickly have a read and tell you that it is exactly same. The company got 100% ordinary shares on 1st October 17. The balance sheet is March 18. Same. The retained earnings shows a credit balance of 6 lakh on 1st April 17, out of which a dividend is paid, and the parent credited the dividend to RE. There has been no fresh addition to other reserves. And then it says there is no opening balance in RE in the books of holding. The following are the changes in the fair value as per the index and the book values. So we're given the fair value of the plant and machinery with depreciations, land and building, inventory, trade payables, I think 100% the same. The figures are different. Try this question out and you'll get confidence. Okay, now let's, I think, have another question. Similar one with the NCI. This is also given in the study material, but I've just organized this question separately for you. So let's look at the question number 5. It says Ram acquired a 60% ordinary shares on 1st October X1 and on March X2, which is 6 months later, the balance sheets are given. The retained earnings shows a credit balance of 60 on 1st April X1, out of which a dividend is paid. Same facts. Ram credited the dividend received to the retained earnings and the fair value of the machinery on 1st October given, depreciation rates given. Following are the increases in the fair values as per the respective index with the book value, same data. Assumed inventory is still unsold on the balance sheet date. Trade payable is also not yet settled. Other reserves on the balance sheet date is same on 1st April. We need a consolidated balance sheet on 31st March. The only difference in this question is NCI.
NCI is there.
And now you will say, how would that NCI make a difference? You'll come to know. Let's begin the journey. Let's go to question number 5. So let's look at the answer to the question number 5. And now I need your helping hands. I think I have been doing the mind mapping. I've been doing the question so far. Now it's your turn. Especially on the step number 2A. The rest, of course, is easy. So let's begin with the step number 1. And we are organizing the two inputs, date of acquisitions and the percentage. So let's see, what was the date of acquisition, beta, if you can give me?
Sir, it is also 1st October
1st
2000
October, sir.
X1.
1st October X1. And I think the percentage is 60%, if I rightly remember.
Yes, sir.
Yes.
So there is an NCI. Now, before I go to the step number 2, I want to put across the question, what is the category of the question? Is it acquisition date balance sheet or at a later date category?
Later date balance sheet with NCI.
Yes, consolidated balance sheet at a later date. Since it is at a later date, we need step number 2A as well as step number 2B. So we'll organize a step number 2A. How many focus points in terms of step number 2A? 3. One is we're looking at the balance sheet of the subsidiary. Number 2, fair value adjustments. Number 3, stock reserves. Upstream or downstream? That was a question. Upstream, of course. So let's begin with the step number 2A, where we're looking at the analysis of other equity. So this is going to be pre and this is going to be post, and we'll define the pre and post as well as we proceed with the question. So let's first of all look at what is pre and post. So this is pre 1st October X1, and anything from 1st October till the balance sheet date, I think March X2 is post acquisition. Yes, the balance sheet date is March X2. Okay, now let's consider the focus point number 1. I am looking at the balance sheet of the subsidiary company. So let's focus on the balance sheet of the subsidiary, and let me ask you, what are you going to do first of all when you're going to do the analysis of this other equity? What's going in the back of your mind? I'm looking at the keyword, Everybody is very silent on the agenda. You're going to make a time scale, right? When you're going to look at the analysis of the other reserves and the RE, we need to make a time scale to begin with. So let's begin with the other reserves, and other reserves we are given the status is the same. So we're going to first start with the other reserves in this case. So let's consider the other reserves. So let's make a time scale. This is 1st April ending on 31st March, and we are given 1st October date of acquisition. So what was my other reserves? 2 lakh. And it says the other reserves on 1st April is same. So this was 2 lakh and this is 2 lakh. I'm sure you can at least tell me pre and post.
Pre,
This
sir.
is 2
This is
lakh
pre.
entirely is pre. There is nothing post acquisition because there has been no change in terms of post period. Next, we are going to look at the retained earnings now. Again, let's make a time scale as well. 1st April, 31st March, and let's get on 1st October. So let's see what is the RE which is there at the beginning of the year, 60,000. And out of which we paid a dividend of 10%. On 4 lakhs, we paid a 10% dividend. So the balance of RE at the beginning is 60 and closing is 164. This is 60 and this is 164. Out of the 60, we paid a dividend of 10% on 4 lakh. That works out at 40. By the way, what is the timing factor when the dividend is paid? The dividend is again paid on 1st November. So we take this difference as well. Can you tell me what is pre and what is post? 20 is the balance available out of 1st April. So what is the pre in the outer column?
The pre
That's
would be
wonderful indeed.
60,000.
Wonderful, 60 and not 20. And the difference, 144 in the time ratio, I think 72. We divide the increase in the time ratio. This will be under the separate heading, that is RE. So till now, there has been no difference at all. But once the NCI comes in, then the focus points will come, right? So this is one focus points, the balance sheet of the subsidiary. Now let's see the continued analysis. So we've got fair value adjustments. So this is continue, this is pre, and this is post. And we need the second focus point, that is the fair value adjustments. So once you're going to consider the fair value adjustments, what is again the focus points to be taken care? Can I say again, I need to consider the time scale for the fair value adjustments again. So let's see the fair value adjustments. So I'm given the fair value of the plant and machinery on 1st October is 4 lakh and the depreciation rate is 10%. Your plant and machinery is appearing in the balance sheet at 270. So 270 is the plant and machinery. So let's go back on the time scale. So 270. So we'll look at the plant and machinery. Let's consider a time scale. 1st April, 31st March. This is 2.7 lakh. So can you tell me what will be the value at the beginning of the year considering a depreciation at the rate of 10%?
So it is 3 lakh.
That's absolutely correct. So this is 10% means represents 90%. Gross it up, you get 100%. Now we need the values in the middle of the year because it was a acquisition date in the middle of the year, 1st October. So what will be the book value on 1st October? Let's take a 6 months depreciation. Earlier we took a depreciation of 30,000. So we need to take 15,000. That's I think 285.
Yes, sir.
And what is the fair value of this asset?
It is 4 lakh, sir.
It is 4 lakh. So we get a gain of 1 lakh 15, which is pre-acquisition. Anything else for the fair value adjustments? Anything else for the fair value adjustments? And that's
Additional
rightly said.
depreciation, sir.
Correct, absolutely. We've got an additional depreciation. Can you tell me what will be the additional depreciation in this case? Not for the first 6 months, but we need to consider the next 6 months. What amount are you going to consider the additional depreciation? We took depreciation on 3, but we should have taken depreciation on 4. So can I say on the additional 1 lakh, we take a depreciation 10% 6 months. That's I think 5,000.
Sir, 5,000.
Correct. So this will be taken as a reduction from the retained earnings column. So a portion of the fair value adjustments done. We continue with these fair value adjustments now. So we've got more fair value adjustments. We continue with the analysis pre-post, and let's consider more fair value adjustments in the question. So I guess there were again 3 fair value adjustments given in the question. Land and building is an increase of 2 lakh, inventory increase of 30, and trade payable increase of 20. So 2 lakh and 30. So land and building increase of 2 lakh, it's a gain. Inventory increase of 30, it's a gain. And trades payable is a loss. That's in the brackets, 20 is a loss. Right, so fair value adjustments are done, and there is, I think, no stock reserve adjustments. Comfortably, let's consider the sum total of this. Is it 657?
Yes, sir. 6,57,000.
Okay, great. 72, and that is 67, I think. Correct. This is post is 67 in nature. Okay, now my piece of advice. Which is a focus point. If there is a dividend in the question, it's going to create some problems to you. And in order to avoid the problems, what I would advise that when you consider your step number 2B and you're calculating the net assets in this particular case, I would advise you calculate 2 net assets. Now hear this carefully. Net assets on the acquisition date still available on the acquisition date. Net assets on the acquisition date still available on the balance sheet date. Get this clear. If you are going to be given an NCI when there is a dividend, if you see dividends in the question and there is a presence of NCI, unlike the previous question, my advice would be that you calculate 2 lists of net assets. One is the net assets on date of acquisition, and it is still available. On date of acquisition. The other one is you calculate on date of acquisition, but it is still available on balance sheet date. Now you would say, what is the difference between the two? I'll tell you. When you are going to calculate a goodwill, please vouch me carefully. When you're going to calculate a goodwill on acquisition date, you'll need which net assets on acquisition date, still available acquisition date, or still available balance sheet date. When I'm going to consider a goodwill, are you going to consider acquisition date, still available acquisition date, or still available balance sheet date?
Acquisition date.
Correct. When you go to calculate your NCI, we need the net assets again, if NCI is a PASNA. So in that particular case, would you need the net assets still available acquisition date or still available on balance sheet date? We need on balance sheet date because NCI will be taken on the balance sheet date. So once you see a dividend, this is relevant for the goodwill perspective and this is relevant for the NCI perspective. So when you go to pick up your calculations, this is what you're going to pick up for goodwill and this is what you're going to pick up for your NCI calculation. The reason, let me emphasize once again. For goodwill, you need the status of net assets on the acquisition date itself. Goodwill is computed on the acquisition date. But when it comes to the NCI, you need the NCI, which is supposed to be there, on the balance sheet date. So you need the status of the net assets still available on the balance sheet date post the dividend. So this net assets, which we are going to consider now, is the sum total of the share capital. Share capital is 4 lakh and this is 657. So this turns out to be 1057. Now, when you see the net assets which is still available on the balance sheet date, now in the outer column, you took this figure of 60, though still available was 20. So you've taken that 40 extra. So in this particular case, you are going to consider 4 lakh, and from this reduce that 40 extra. This is 6 lakh 17. So this is going to be 10 lakh 17,000. Did you get my point? This is a crucial point to be kept in mind. So when you see a dividend in the question, and in this particular case, there is an NCI. If there is no NCI, we don't need these two net assets. But my advice is that if you get an NCI with a dividends in the question, in the step number 2B, please organize these two inputs. Because for goodwill, you need what is still available on acquisition date. For NCI, you need available what is still available on the balance sheet date. I hope you got my point. Now let's go further. So this was step number 2. Now let's have a look in terms of the step number 3. Step number 3 is my purchase consideration. And I think that you can directly pick up investment in the balance sheet. So my investments is appearing in the balance sheet to the tune of 8 lakhs. So we can directly consider 8 lakhs itself. That is the PC. And then we go on to the step number 4. And in terms of the step number 4, we need now the NCI. Now be careful. Now be careful as you calculate the NCI. In terms of NCI now, I need the NCI on date of acquisition. What is the figure which you are going to consider now? 1057 or 1017 still available on acquisition date or still available on the balance sheet date? Ten lakh 17,000. And what is the NCI? I think 40%, because 60% belongs to the parent. That's right. You gave me 1057. No. You need to consider 1017 out here. NCI is being computed on date of acquisition, but it is for the purpose of balance sheet. So we need to consider what is still available on balance sheet date. So 10 lakh 17 into 40% is 406,800. This is not going to match with India's 103. This is not going to match with India's 103. In India's 103, you would have taken 1057 at that time, but that was computed on the acquisition date itself. But now you need the NCI for balance sheet perspective. So we need a reduction of dividends. And then add the share in post-acquisition profits. Let's add the share in post-acquisition profits. And you'll see something wonderful coming ahead very soon as well. So what was the post-acquisition earnings? 67,000, and 40% of this belongs to the NCI.
26,800.
26,800, and this will give us the amount of NCI. There is no goodwill impairment in this case.
4,33,600.
4,33,600. Now watch this. What I am about to do is even more interesting. Step number 5. So we're now looking at the step number 5, and in terms of the step number 5, we need a goodwill or a capital reserve. So we take the purchase consideration, that is 8 lakhs, and to this we add NCI. Tell me what is the NCI to be taken. Tell me what is the NCI I am supposed to take in this particular case. Shall I consider this NCI that is 406,800? No. So just a few minutes back you said, when you did the mind mapping, you said you need to take the NCI on the acquisition date, but I need the NCI based on the net assets still available on the date of acquisition. Did you get my point? I cannot afford to take this figure. I need to consider the NCI based on 1057 into 40% because this is the goodwill which is based on acquisition date. Moral of the story: if there is a dividend, organize two net assets in step 2B. And if you want, organize two NCI, one NCI for step numbers 4, one NCI for step number 5. Do revise this. I know this is technical indeed. NCI has made some real impacts on the question. So this is based on what is on the acquisition date, still available on the acquisition date. This is 422,800. So this is 12,22,800, and we compare this with the net assets. What was the net assets on the acquisition date? Now, you need to be careful further again. Is this net assets the one which is 1017 or 1057? Tell me. Which net assets? That's right. This is 1057. You need to maintain the parity as well. And you'll see the parity getting maintained here. Even the NCI is based on the same figure. So be careful as you pick up the informations in this case that your NCI calculations post-dividend, your goodwill NCI pre-dividend, your net assets pre-dividend, what is to be taken where is the game. So let's consider the difference as the amount of goodwill. 165,800 I think is the goodwill.
Yes, sir.
Correct. So 165,800 becomes the goodwill. This is my step number 5. So now we can take the step number 6 as well. And step number 7, consolidation, is just an additions. So let's see the step number 6 as well. So step number 6 is making the consolidated balance sheet other equity. And I guess we can again make a small little formatting for the consolidated equity. Basically focusing on the tab 2 and 3 only, not on the tab number 1. There is no compound financial instruments. So we'll first pick up the tab number 2 information. There is, I guess, retained earnings only. And the tab 3, I can take it as other reserves. So here again, we've got how many focus points now? In terms of this now, how many focus points? I'll say 4. Post profits. Focus number 2, upstream, the downstream, the downstream stock reserve, goodwill impairment, and dividends. So let's consider the information. Let's see what is the holding company's own RE as well as other reserves in the balance sheet. So let's see what is the figure in the balance sheet. I guess it is 6 lakhs for other reserves and 1,14,400. 6 lakh is for other reserve. So 6 lakhs for the other reserves, and RE was, I think, 1,14,400, correct?
Yes, sir.
To this we add the share of holding in subsidiary post acquisition profits. Look at the analysis. What was the post acquisition profit? 67, is it?
657 था.
Post
And the
acquisition.
post tax 67,000, sir.
Right, 67,000 into 60%.
40,200.
40,200, and there is no goodwill impairment, there is no stock reserve, but we need to take care of the dividend elimination. So I think the dividends which was paid was 40,000. Out of which 60% belongs to the parent. It's not an income from the group point of view. I think that's it. So let's see what is the figure out here.
1,30,600.
This is 1,30,600, and this is 6 lakh. For the balance sheet, we can just add, this is, I think, 730,600 is the total. Right. So now we can make the consolidated balance sheet as well. You would like to make me the balance sheet, or is it manageable?
So manageable.
I think so as much. So consolidated balance sheet, you can prepare as a part of the homework exercise in this case. Right. So this was, the case number which we did. Today we've been concentrating on a case where the balance sheet is made at a later date, where we saw with without NCI. So if you notice, I've done all the four cases with you. I've done the case category 1 questions when the balance sheet is made acquisition date and with without NCI, and then I've seen later date also, that is with without NCI. So now it's time to do some practice. But before we do the practice, time to give you a break as well. I am going to do a little comprehensive question after the break with you, which is actually an examination question which came in June 2019. June 2019, not May 2019. The exams got a little postponed, and that was not due to COVID. I guess COVID was later, but this was for some other reasons. But I think first let's give you a break, and then we'll start a journey back on a practice question with you. So let's give you a 10-12 minutes break, friends, and I'll join you after the break. Relax your minds. So we have done our entire base understanding for the consolidation. I think it's now time to do a comprehensive question with you, which I said is an examination question, came in June 2019. So let's take you to a very interesting question. This is an examination question. June 2019, it came for 15 marks in the exam. So let's, I think, read the inputs first of all in this particular case. It says the summarized balance sheet of PN and SR on March 18 is given. So we're given the balance sheet on March 18. And then it says in the additional information that PN acquired 70% equity shares on 1st October 17. The retained earnings of SR showed a credit balance on 1st April 17, out of which a dividend of 12% is paid on 15th December. PN credited the dividend received to its retained earnings. So what he did for the standalone statement is correct. The fair value of the plant and machinery on 1st October 17 is given and the depreciation rates are given. The following are the increases in comparison of the fair value with the book value on 1st October, which needs to be considered in consolidation. Inventory is still unsold and the trade payable are not yet settled. Other reserves on March 18 as well as on 1st April 17 is same. The business activities of both the companies are not seasonal and therefore it can be assumed that profits are earned evenly throughout the year. We're required to make a balance sheet on March 18 for the group as per Ind AS. So the only agenda is again in terms of NCI. The question is quite similar, absolutely. So we need to keep the focus points clear. Our focus points would be in terms of the net assets calculations, the NCI based on which net assets, the goodwill based on which net assets. That is the focus point. So I think let's begin the journey and you are going to give me a helping hand. I am just endorsing things further in terms of this question. Let's begin question number 6. So let's, I think, start with our basic inputs in terms of step number 1. I don't think so. I'm asking you what is done in step 1 because we are very comfortable that what is done in step number 1. You need to get the date of acquisition and you need to get the percentage as well. Okay, consolidated balance sheet was tallied in the previous question. Wonderful indeed. That is superb. So I guess first of all, if I'm looking at the date of acquisition, it is 1st October 17. My date of acquisition is 1st October 17 and the percentage is 70%, simple and straight. Now let's go to the step number 2. Before we go to the step number 2, can you tell me what is the category of the question? So what is the category of the question? Is it a balance sheet on acquisition date or is it a balance sheet at a later date? It is, of course, at a
Balance
later
sheet
date
at
in this
later
case.
date.
Yes. So I'll have to do the step number 2A as well as the step number 2B as well. The idea of doing this question is to give you more confidence. There is hardly anything much new in this question. I will do some more interesting questions in the next class because I need to add the concept of chain holding as well. So I would be adding some more elements like the extract balance sheet and then the concept of chain holding and then the concept of consolidated income statement, etc., etc. So in this particular case, we are now focusing on the step number 2A. So in terms of step number 2A, we're looking at the analysis of other equity. So we consider the pre-acquisition and we consider the post-acquisition, and let's define this in terms of dates. So we know the date of acquisition is 1st October 17. So this is pre 1st October 17. and anything from 1st October till the balance sheet date, that is March 18, is post. So when you proceed with the question, be very careful on the approach. Your focus should be completely on that particular step. Now, tell me, how many focus points are there in terms of the step number 2A? Focus points. Total number of focus points, that's right, 3. So we're going to first start with the balance sheet of the subsidiary company. And as we make the balance sheet of the subsidiary, we are now first of all looking in the balance sheet. There is an other reserves of 312, and there is a retained earnings that is 255,800. So as you look at these items, what should come into the mind is time scale. Get it very clear. Don't violate these steps. So we take the other reserves, that is 312. So let's consider the other reserves. We're going to consider a time scale 1st April, 31st March. So first, let's pick up the balances at the beginning of the year. Let's go back to the additional information. It says in point number 7, the reserves on March 18 is same as 1st April 17. So the position was 312 at the beginning. The position was 312 at the end. So I think you can easily decide how much is pre and how much is post. I don't think so. I need to ask you that. This is undoubtedly pre. So 312,000 undoubtedly becomes pre-acquisition. Then we go to the next agenda in the balance sheet, and that is a retained earnings. We again make a time scale that is on 1st April and on 31st March. Let's go back to the balance sheet. Now, wherein when I feel the good questions coming in, I'll definitely put the questions to you. The idea is to give you more grip, and please practice these questions what we have done today by your own hands. Don't sit down and watch the solutions. You need to solve this by your own hand. So first of all, if I'm looking at the RE is given in the additional information. In point number 2, the balance was 93,600, out of which we paid a dividend of 12%. So let me note down 93,600 is the balance at the beginning. And the balance at the end is 255,800. So this is 255,800. Noted down the balance. Now tell me that it says in point number 2, you paid a dividend of 12% on this. The share capital is 624. So what is a 12% dividend on 624?
74,880.
That's right. 74,880 is the dividend. So let's see what is the balance left over. 18,720. Now you need to tell me what do I write in the outer column as far as 1st April balance is concerned. Do we write down 18,720 or do we write down 93,600 in the outer column?
So date of payment of that dividend was, what was that, sir?
Okay, the date of payment was 15 December post the acquisition date.
Yes, sir. So balance will appear at 93,600.
Wonderful indeed. We put 93,600 in the outer column. And let's see what is the increase. 18,720 versus 255,800. And I think that's again 6:6 time ratio. 118,540.
Yes, sir.
That's great. So my first block of adjustments are done. We've concentrated on the balance sheet of the subsidiary company. Now comes the fair value adjustments. We extend the analysis. So let's make the extension of this analysis. So now we're going to focus on the fair value adjustments now. So this is pre-acquisition and this is post-acquisition. So let's concentrate on the fair value adjustments now. So in terms of the fair value adjustments, we go back to the question. And we're given some inputs. Somebody's noise at the back, please. So we go back to the inputs in this particular case and we look at the point number 4 and the point number 5. The point number 4 says the fair value of the machinery on 1st October 17 is 624 and the depreciation rate is 10%. My plant and machinery is appearing at 421 200. So let's go back. Let's make the time scale. So we consider again the time scale 1st April and 31st March. So what was the value at the end of the year? I think I just forgot the figure again.
421 200.
421 200. That's right. So we consider 421 200 and my depreciation is I think at the rate of 10%. So this represents 90%. Let's gross it up to 100% as well.
468.
468 is the value at the beginning that represents 100%. Now our date of acquisition is 1st October. So what was the value at which this asset was taken?
446 600.
624, I think. This was revalued at 624. Okay, you're talking about the book value. I was talking the fair value. So fair value is 624. And let's also get the book value on middle of the year. Considering a depreciation only for 6 months, that is 444 600.
Yes, sir. Book
We get a
value.
gain. That's right. 179 400, I think, is the gain. That becomes pre-acquisition nature. Let's now consider the additional depreciation as well. And what is the amount on which the additional depreciation will be computed? Of course, we are concentrating on the next 6 months. So what is the figure on which depreciation was computed? 468, but you should have taken it on 624. So 624 versus 468, we should have taken a depreciation extra on 156, 10%, again for a period of 6 months. Because we took a depreciation on 468, but we should have taken a depreciation on 624. So on the difference, we consider, I think it's
7,800.
7,800. Correct. So this will be in the brackets out of the retained earnings as well. Quite absolutely comfortable indeed. We continue with this analysis further. We've got more fair value adjustments. So we've got more fair value adjustments. Let's consider the further fair value adjustments as well. So if we go back to the question, in point number 5, I am given the status of the land and building increase 3,12,000, inventory 46,800. So this is land and building increase by 3,12,000. What was the increase in inventory?
46800.
46,800. And there was increase in trade payable, I think 31,200. That's a loss because fair value increase is a loss for a liability. Okay, and I think we are not given any stock reserve adjustments as far as upstream is concerned. So this is done. We can now comfortably take the pre and the post. I think as I'm doing this question, I personally feel that you would be getting more confident on this now because it's more like, a systematic procedure and this is nothing too different as compared to the previous one. So you should be getting a more confidence as well. So let's see the pre and the post figures. Is it 1031 140?
Yes, sir.
Correct. So
And
this
the
is
post,
coming to 1031 140 is pre.
1,10,740.
Okay, for the post.
Yes, sir.
1,10,740 is post.
7,440.
Great. Now comes the crucial steps further in this particular case. As I said, get into the habit of organizing the two net assets when there is a dividend and there is an NCI. So I'm going to organize in terms of the step number 2B. I'll organize my net assets. So we're going to get two net assets. One is still available. One is still available on date of acquisition, and one is still available on the balance sheet date. So every time you see a dividends in the question and an NCI, I think this is the best way you organize your two net assets in this case. So tell me what is still available on the date of acquisition? Which is this figure still available on acquisition date or the balance sheet date?
Equity share capital plus that pre-profit.
Right. So we'll take the equity share capital was 624, if I remember rightly. And this is going to be 1031,140. So let's see. 1031,140 plus 624. That's, I think, 1655, 140.
140.
Okay. And what about the balance sheet date still available? What do we add to this 624? Can I say reduce it by 74,880, which is the amount of dividends? Correct?
Yes, sir.
Right. 74,880. So reduce this 1031,140 by
1580, 260.
74,880. This is 956,260 plus 624. That makes it 1580,260. Correct. So I think this is one thing which we have added in terms of step number 2B to organize the net assets on acquisition date, still available on acquisition date. On acquisition date, still available on the balance sheet date in this case. Okay, so this is my step number 2. We go on to the step number 3 now. So now let's have a look at the step number 3. So in terms of the step number 3, we need a purchase consideration. And for the calculation of the purchase consideration, somebody's got a lot of noise in the back. If you mute yourself, I think in the
If
rating, you've
planning
got so
plus
much noise. Okay, now it's, I think, better. So now we move on to the next one, and that is the investments in the balance sheet. The investments in the balance sheet is appearing at 12,48,000. So we go to 12,48 is the PC. So this is 12,48, and now again important input starts. We've got step number 4 where we're calculating the NCI. So when I'm calculating the NCI, we need the NCI on date of acquisition. And you know, the best part is that if your NCI turns out to be at a fair value, then I'm safe. Because if your NCI is at a fair value, I don't need to consider that whether we need net assets on acquisition date or on balance sheet date. But if it is at PASNA, then I think the trouble remains. Now tell me, what is the net assets you're going to consider for NCI? 1655 or 1580?
1582.
Wonderful indeed. 1580 to 60. Because we need the information which is still available on the balance sheet date. Because when you're calculating the NCI, we are calculating the NCI which is going to be presented in the balance sheet. So we need the status of the net assets still available on balance sheet date. And I think there was a 30% NCI, I guess.
Yes, sir.
Correct. So that
474.
works out.
4,74,078.
Wonderful. That's correct. And then we need to add the share in post-acquisition profits. We add the share in the post-acquisition profits as well. And we need to see which steps for this purpose. Step number 2A, the post acquisition is 110740. So we take this as 110740. 30% of this belongs to the NCI.
33,222.
Correct, 33,222, and this will give us the NCI on the balance sheet date. So I think just to put the focus very clear that this is the information which is net assets on date of acquisition still available on balance sheet date, still available on consolidated balance sheet, because you are calculating the NCI on the balance sheet date. These are small little points which should be very crystal clear in your mind when you're doing the question in the exam, what information is to be fitted where. So this I think comes to
5,07,300.
5,07,300 is the total. Great. Now we go on to the step number 5, and in terms of step 5, we need a goodwill or a capital reserve or a bargain purchase gain, whatever you can call it. So now when you're calculating goodwill, another focus points which comes to the mind is the net assets, what are to be taken. So which net assets are we going to take now at this particular stage?
Date of acquisition.
Yeah, so we'll take date of acquisition still available on acquisition date. So let's get the focus here also very clear indeed that you're going to consider
60,55,40.
the purchase consideration plus the NCI and compare this with the net assets on acquisition date to get the goodwill. So one thing which I pinpointed earlier as well, that now don't take the mistake of taking this NCI. You cannot take this NCI, because this is based on a different figure, so I can't afford. If there was no dividends in the question, I could have taken this NCI, but now I can't afford to do that. So we got to consider 1655,140. So let's give the focus point here as well, that we need to consider the net assets on date of acquisition still available on date of acquisition. It is still available on date of acquisition. Why? Because you are calculating the goodwill on the date of acquisition. So get the focus mapping clear. NCI is on balance sheet date, so we need still available on balance sheet date. Goodwill is acquisition date, so we need what is still available on acquisition date. So your NCI is going to be 16,55,140 into 30%.
4,96,542.
4,96,542.
542.
PC is 1,248.
So goodwill 89,402.
Okay, I'll just take this total as well. 17,44,542.
44,542.
Okay, great. 89,402.
Yes, sir.
Right, so we get a goodwill which is 89,402. Now you can see the same question took us a lot of time to do. Now similar kind of question, once you get the grip, you're going to do it very fast indeed. Now we go on to the step number 6 as well. So let's see the step number 6. So step number 6 is in terms of getting the consolidated balance sheet, which is other equity. How many focus points in terms of the balance sheet equity? Total number of focus points. I'm afraid not 3. It's going to be total of 4 focus points, right? One is the post-acquisition profits. One is the goodwill impairment. One is stock reserve, which is downstream, and dividends. So let's consider, because we need to eliminate from a group point of view the dividends as well. So let's organize the data in terms of tab 2 as well as tab 3. So tab number 2 and tab number 3. So we take retained earnings and we take the other reserves. I am indirectly assuming that this other reserves is all a part of the tab number 3 in this case. So let's consider the holding company's own equity. So let's see holding company's own RE as well as reserve. So we go back to the balance sheet. Oh, we've got far away. So in terms of the other reserves, it is 936 and the retained earning is 178,400. So other reserves is 936. This is 936. And what was the retained earnings? 178,400, right?
Yes, sir.
Great. Now let's consider the share in the post-acquisition profits. So we add the holding share in subsidiary post-acquisition profits. Where do you pick this information from?
So that calculation we did for pre and post, we will take
Correct.
70% of
110. Yes, 110740. Step 2A. So 110740. So we've got
77,518.
110740 into 70%. Can you come again, beta? How much was it?
77,518.
77,518. And then there is no goodwill impairment, there is no stock reserve, but we need to take care of the elimination of dividends because it does not represent any income from the group point of view. How much was the dividends?
74,880.
Right, the dividends was to the extent of 74,880. So we take this 74,880, out of it 70% the parent company got.
52,416.
52,416. Okay, that's great. I think that's it. We can now easily get the sum total of the other equity in the balance sheet as well. So this of course continues at 936.
And this one, 2,03,502.
2,03,502. Okay, that's great. So we can just add the two as well to get the sum total, which will appear in the consolidated balance sheet as well.
11,39,502.
Right, 11,39,502. Okay, I think let's make the consolidated balance sheet also to you. We get a good feel factor. So let's go to the step number 7. So in terms of the step number 7, now we need to consider the consolidated balance sheet. Starting with the asset side, we need to incorporate the fair value adjustments as well. So let's consider land and building and take the fair value increase 3,12,000. So let me just write down. No, I think I just promised something. I will do that. So let me do one thing. Let me present it the way you need to do it in the exams to save your time. So let's do one thing. Let's make it on a fresh page. So let's see the next page. I am going to show you how you can present it in a very good manner in the exams. So let's make a proper balance sheet to you. So what you can do in the exams, present something like an Excel sheet. And this technique can also be used in terms of P&L later. So this is the particulars of the balance sheet, the holding figures, the subsidy figures, the adjustment figures, and the total. This saves you a lot of time in terms of, making working notes as well. So this would be a good idea. So this is my consolidated balance sheet. So we'll start with the asset side and we'll go with the non-current assets. This is holding company, this is subsidiary company, this is adjustments, and then this is the total. So what you were asking me, how do you present? I think this would be a very good technique of presenting things. So I'll now need your inputs in terms of the figures. So I think let's go with the Schedule 3 presentation. So technically it should be a property, plant, equipment in which we've got two items, land and building and plant and machinery. So we'll first focus on the individual balance sheets of the parent. So what is the land and building of the parent? 468.
Yes, sir.
And subsidiary, I think, is 561,600.
Yes, sir.
And there was a fair value change, increase 3,12,000. Had there been any depreciation, we would have taken the impact as well. So let's see what is the sum total.
Sir, it is 13,41,600.
13,41,600. Great. Next, we can go for the plant and machinery. It is 748,800. Then I think subsidiary is 421,200. Look at the analysis of equity. What was the fair value gain on the plant and also the additional depreciations as well. See the fair value gain in the analysis.
179,400.
Okay, so this is 179,400. And what was the additional depreciation?
7,800.
7,800. So now we can take the figures in the outer column. So that makes it aesthetically a better presentation as well. Same, I think, 13,41,600.
Yes, sir.
Correct. Okay, the next item in the balance sheet is investments. That won't be taken, but I think we calculated a goodwill. So there was a goodwill on step number 5. What was the goodwill?
89,402.
89,402 was the goodwill. Great. Then next, this is on the non-current assets. Let's go with the current assets now. So we've got inventories. So for the inventories, we've got parent is 374,400. Subsidiary is supposed to be 113,600. And I think there was a fair value adjustments again. What was the fair value? 46?
800.
800. Okay, so no stock reserves. Otherwise, we could have taken the stock reserve impact as well. 534,800.
Yes, sir.
Great. And then we move on to the trade receivables, next item in the balance sheet. And that's to the extent of 186,500. So 186,500 for the parent, and for the subsidiary 124,800. And I think, was there any fair value adjustments? I think no.
No. Total comes to 3,11,300.
3,11,300. And then we can go for the next item, cash and cash equivalents. And that's, I think, 45,200, 24,900. There has been no adjustments in this case as well.
70,100.
70,100 is the total. So this, I think, takes care of the asset side of the balance sheet. So let's see the sum total.
36,88,802.
Sorry, can you come again, beta? 36 lakh.
88,802.
Okay, 36,88,802. Okay, this is on the asset side now. We can now continue this format for the liability side as well. So let's see the focus in terms of the liability side as well. So this can save you a lot of presentation time, making the presentation good as well, and at the same time giving the inputs clearly. So this is now the equity and the liability side. This is holding company, subsidiary company, adjustments, and we get the total. The balance sheet continued. Okay, so first we start with the equity side on the balance sheet. So on the equity side, let's now consider the equity share capital. So that will be only for the parent company. So equity share capital, I think 1560.
Yes, sir. 15,60,000.
So if you want, you can also show an alternative presentation like this, that you can take 624 in the column out here, and then you can show the adjustment 624. So if you don't want to show this, that's okay. But I think since you're making these columns, it'll be good that you can show that even for investments. Then there is other equity. So we have already taken the other equity, which is how much in the step number 6?
11,39,502.
11,39,502. Great. So that's on the equity side, and then we are only given current liabilities, no current, non-current liabilities. So there is a trades payable. The trades payable is 146,900. And for the subsidiary, it is 34,300. And I think there was a fair value change for a trades payable as well.
31,200.
31,200 is the increase. So we get the figure in the outer column. And least I think we forget we need to take an NCI. So what was the NCI also? Let's take that. What was the NCI? Step number 5, 4, 4.
It is 5,07,300.
5,07,300.
300.
Okay,
Yes, sir.
great. And then we can get the trades payable as well. I think that's 212,400.
Yes, sir.
And then we're given the short-term borrowings in this case. And the short-term borrowings is 249,600. And it is 20,000. There is no adjustments in this case. So I think this is 269,600. So hopefully now this balance sheet should tally. If it tallies, that means you've done a good job. Let's see if the balance sheet is agreed on this.
Tally, sir.
Valid. Wow. So the total is 36,88,802. Wonderful. So that was 15 marker examination question. Now, before we go further, I think it's time to, get your comfort zone scores at this stage, because we've done all the 4 cases with you, whether it is acquisition date with without NCI, or it is supposed to be later with without NCI, and with the dividends impact as well. So let's get your comfort zones on a scale of 10 at this stage. 200%, very good. 10 out of 10, super. Okay, I think there's a message also on the chat box. If you could please, those who have not shared your registration numbers, please share the things for the records of the institute. So if you can just share that on the chat box for those who have not shared it, please do the needful. Okay, now I think I want to add some more inputs at this stage. We may not be able to complete this question, of course, but this is a question which came in the exams in this came in the exams in June, in January 21. Oh, this also gets cut. Something went wrong on this. Anyway, let's see. Oh my God. I guess I'll just keep it like this. Better to keep it like this only. Something went wrong on the editing part. System also feels heavy, when you do all those complications. I hope the questions is clearly visible, right? Is the question visible, clear?
So it's somewhat a blur, sir.
Okay, just give me a second. I think there's something went wrong. I'll just load the file once again, I guess. Just give me a second. Yes, I think now it is perfect. Correct. Let me just. Now I think it should be visibly clear. See, this is clear to you now?
Yes, sir. Readable.
Okay, perfect. Now, this is a question which came in January 21 in the exams, so 15 marks. Of course, we will not finish in the next 10, 15 minutes. But the idea is to, add on some more things at this particular stage. One extra crucial point was there, which I want to add on this stage, connect you to Index 103 as well as Index 110. Let's read the inputs to you. It says on 1st April 17, A acquired as 80% share capital, so 20% NCI. And then it says on the acquisition date, the share capital and the reserves are given to me respectively. I have a small little question. Since the share capital and the reserves on the acquisition date is already given, can I avoid doing my step number 2A? Think carefully before you answer. Considering that the share capital and the pre-acquisition equity, which is the reserves on the acquisition date, is given, do we need an analysis of equity? Think carefully and say yes or no.
No.
You mean to say I don't need an analysis?
So since
I
the
think
acquisition date is 1st April and the balance given for the profits also, it will comprise of the pre and share capital will give us
yes,
the
he's
date of
giving you
acquisition
the
date later.
acquisition date reserve itself. So is there a good need? Is there a need to do analysis? Yes or no? Okay, I think I'll answer that. Majority of the people will always think that if this is already given, what is the good need of doing the analysis? Don't get into the trap. The reason is that in this case, if you remember, my analysis of equity has got 3 focus points, not only the balance sheet reserve, but also the fair value adjustments, right? So this figure is without incorporating the fair value adjustments. So don't get into the trap. I hope I made sense.
Yes, sir.
Okay, that's great. Then it says A paid an initial cash consideration to the extent of 10 lakhs. Additionally, he issued 2 lakh shares with a nominal value of 1 per share at the current market price. It was also agreed that A would pay a further sum of 5 lakh after 3 years. What is this? The money which he's going to pay after 3 years, what is this?
Purchase.
Deferred
Yes,
consideration.
it is right. It is a deferred consideration. And then it says the appropriate discounting rates are given. The shares and the DC have not yet been recorded by A. The moment you see this, extract balance sheet. I said earlier when I gave you the mind map today that sometimes you'll see some omissions of information, which would mean that you need to make an extract balance sheet. Now, I just want to concentrate on this particular point, not in specific to this question, but in general. Because we need to be clear in terms of 2-3 agendas which can trouble your extract balance sheet. So let's now do a bit discussions on the concept of extract balance sheet. So I'm now going to give you a very simple little chart so that we get our fundas very clear on the extract balance sheet. Number one, the question rises, when do I prepare my extract balance sheet? I'm going to make my extract balance sheet when there is some kind of omissions. And these emissions typically could be in terms of purchase consideration. Like in this case, it said you gave some shares, the entry not done. You gave some DC, the entry is not done. Now, watch this very carefully. So the extract balance sheet will be required when there is omission. So I'm going to concentrate on 3 examples of omission. I'm going to concentrate on 3 kinds of omissions so that I can incorporate them in my extract balance sheet as well. So I am putting things in 3 phases. I'm looking at number 1, the type of omission. What is the type of omission that will decide the fate? Second, we need to see what should have been done on date of acquisition, what should have been done in a post-acquisition period, and then what is the impact on the extract balance sheet as well. Now watch this carefully. I'm going to give you 3 inputs because when you are going to do a full-fledged questions, omissions will mean before the 7-step model, extract balance sheet. Let's begin. Let's say there were equity shares issued as a part of the purchase consideration. I'm looking at that there is equity shares issued as a part of the PC. If he omitted to put this entry, can I say I need to visualize what should have been the entry on date of acquisition? So my entry on date of acquisition would have been investment debit, equity share capital credit, and any premium would also get a credit, right? Had you put this entry at the date of acquisition, you would have recorded the investment and correspondingly the equity share capital with the face value and the premium with the excess would have been recorded. Will there be any change in this investment after that? No. Will there be any change in the equity share capital? No. Will there be any change in the security premium post the acquisition date? No. So there will be no changes which will be coming in this particular case. The investments would remain the same, the equity share capital as well as the security premium, everything is going to remain exactly the same. So which means you can directly change which figures in the balance sheet. You can change the equity share capital of holding company. That's 1. You are going to change the investment in the balance sheet. That's 2. And you're going to change the security premium as well. Got my point, I guess. So in this particular case, if there is omission of equity shares, put this entry and make the changes of these 3 figures in the balance sheet. Next. I'm now looking at the second agenda, and the second agenda is that I am looking in terms of the fact that if there is a deferred consideration, connecting the dots again in terms of Ind AS 103. Had there been a deferred consideration, what would have been the entry? The entry which you would have done on the date of acquisition is investments debit and the deferred consideration gets a credit. Can I say this will be at the present value of the future outflow? I guess now comes an interesting question to you. Is there going to be any kind of subsequent accounting related to this DC? Because there could be a gap between the acquisition date and the balance sheet date. Any subsequent accounting required?
Unwinding of discount.
Wonderful indeed. So what I'm going to do in this particular case, I will do the unwinding of discount, and the entry will be finance charge gets a debit and the deferred consideration gets a credit, and this will be for as many years as the post acquisition period is there. You have to keep unwinding it for the entire period. So what changes in the balance sheet? What are you going to change in the extract balance sheet in this case? Number one, you're of course going to change the DC. Number two, you're also going to change the investment in the balance sheet. And remember, when you are going to change the DC in the balance sheet, you'll split the DC between current and non-current. Because if it was payable, let's say 3 years later, 2 years have already passed. Now it means the remaining consideration is current in nature. So you'll have to decide in the balance sheet, is it current liability plus non-current liability, or just non-current liability, or just current liability. Because it can be partly current, non-current, it can be completely current, or it could be non-current in nature. And number three, what else do you change? You need to reduce the retained earnings by the finance charge. You need to reduce the retained earnings on account of the finance charge. This finance charge which is recorded is going to be also reduced in this particular case. That can be a second category of omission in terms of the purchase consideration. And you can definitely guess the third kind of omissions as a part of the PC. And that would be contingent consideration in the shareholder's capacity. And in this particular case, what you'll do, you will put the entry investment gets a debit and the contingent consideration gets a credit, and this is at a fair value. Any subsequent fair value changes to be done? Any subsequent fair value changes would be required to be done for this contingent consideration? 103. It all depends upon the fact whether this contingent consideration is equity instrument or is it a financial liability. If it is equity instrument, no changes. If it is a financial liability, fair value changes to be captured. So this contingent consideration, if it is supposed to be equity instruments, then there would be no changes. But if it is a financial liability, you will capture the fair value changes. You will capture the fair value changes in this particular case, putting the entry P&L debit or P&L credit as the case may be. So what changes in the balance sheet when you make the extract balance sheet? Number one, of course, the investment changes. Number two, the contingent consideration changes, and that again, you'll have to reflect, is it completely current or non-current, or a blend of current and non-current liability put together. And can I say the RE will either increase or decrease because of the fair value changes as well. I hope, friends, I have made my points absolutely clear.
Yes, sir.
So let me just, I think, consolidate the points, because this is one more edition preceding my 7-step model. So when you're going to attack a question and if there is agenda regarding any omissions of PC, look at the category. If it is equity shares omission, not an issue. But if it is a DC or a CC omission, you need to connect the dots back to 103. In a DC omission, there is unwinding. In a CC, depending it's a financial liability, there will be fair value changes, and accordingly, these things will change in the balance sheet of the company. And when you make the extract balance sheet, just incorporate the changes in these value. Rather, first pen down the entries and then make the extract balance sheet and then proceed with the 7-step model. So January 21, this is what the question added on. They gave you the concept of omissions where extract balance sheets were required to be done. I will be doing that question with you in the next class, and I will also be introducing you to the concept of chain holding consolidations as well. And then we'll move on to the consolidations of income statements and the cash flow statement consolidations as well. All that is going to be done in the next class. I think that's all we have almost time for. over to you, friends, for any questions on your side. But my sincere request again, whatever we have done, the questions we have done today, please practice by hand. So could you take a question with a stock reserve in the upcoming class as well? Yes, we'll do that. I'll take a question which contains a stock reserve inputs as well.
So, the questions that you are taking from that question sheet has been uploaded, sir.
This entire file will be better uploaded, including the questions.
Okay, sir.
So you make my Uttarayan very much wonderful by providing this wonderful lecture since morning. Thank you. Oh, wonderful. I think that reminds me, today is Pongal as well. So I think it's celebrated in different parts of the country with different names. So wish you all, of course, a very happy Pongal as well. Thank you very much indeed.
So happy Sankrant from Maharashtra.
Thank you. Thank you very so much. And my good wishes to all of you as well. My good wishes, my wishes to all of you as well. Thank you very much indeed.
Sir, actually,
Sir?
in Gujarat, today is the Makar Sankranti, the kite festival. And since you have started the lecture, I really very much happy.
That's great. That's great. Thank you very much indeed. I didn't realize when I started the class, that today is a day where I should wish you, but I think that's quite great. So my good wishes to all of you, and thank you very much indeed to all of you. So I'll see you in the next class. Please revise. Bye bye. Take care. Thank you.
Thank you, sir.
Thank you very much.